I look at strategy stock down about 27% over the past month. Are investors losing faith in the Bitcoin movement?
No, I don't think they're losing faith. If you're an investor, it really comes down to what your time horizon is and how much volatility can you stomach. So if you want max performance, you're going to take max volatility. Strategies up 75% a year on average for the last 5 years. So you can actually outperform Bitcoin if you buy an equity that's amplified like MSTR. If you don't want to trust anybody, you want no counterparty risk, you buy Bitcoin. Bitcoin's up 50% a year over 5 years. No counterparty risk. It's very straightforward. You're getting the benefit of the crypto economy, but you're not on the volatility roller coaster. So everybody's got different risk tolerance. They've all got different pools of capital. The good news this year is now you've got a variety of different instruments you can use to ride the digital wave.
Michael Saylor explores crypto risk, digital asset treasuries, and bold Bitcoin moves. Stay tuned to dive deeper into his vision today.
I don't really think about Jim Chanos. I think that there'll be some skeptics. They don't really appreciate what Bitcoin is doing. They don't understand digital capital. They don't understand digital credit. But at the end of the day, the big dynamic in the industry is digital capital has gone from nothing to $2.5 trillion over 15 years. Digital credit didn't exist 12 months ago. We've issued nearly $8 billion of digital credit. Digital credit is got a tax equivalent yield of 4 times higher than bank credit. You can have a bank account, in New York City that pays you 4% and it's taxable, or you could buy something like STRC that pays you 10.5% that's tax deferred. So the market's evolving, and the short sellers aren't really interested in the impact of AI or the impact on digital assets to change the way the world works. They're just interested in being skeptical as a business. So I don't really focus on them. Nothing great has ever been created by a short seller. Well, I think the money market industry is massive. There's $30 trillion worth of assets invested in treasury-type instruments in the United States. Stretches about 1% of 1% of that industry. It's about a $3 billion issuance. And the big idea here is you take an asset appreciating 50% a year with a volatility in the mid-40s, and you strip the volatility from 45 down to below 5, maybe to 2, 3, or 4, or even 1, and then you extract about 10% dividend yield. And if you do that, you end up with something which is yielding 6% more than the risk-free rate. And when the vol gets to 1, you've got a Sharpe ratio of 6. So we're really engaging in financial engineering to distill pure currency yield above the risk-free rate. And of course, the common stock shareholders in MSTR get the difference between the 10% that we pay and the 50% that Bitcoin's been performing. Long term, the math is pretty simple. We expect Bitcoin to appreciate about 30% a year for the next 20 years. We expect to pay about 10% dividend yield on the preferreds. 2/3 of the benefit go to the common equity shareholders, and most of the volatility is stomached by the common equity shareholders and the corporation. And the credit investors get this pure 10% return of capital dividend. That means it's tax deferred. They don't have to pay tax on it until they sell the underlying instrument. And that means that they're able to invest in a credit instrument that pays them a 10% dividend instead of holding a money market that pays them 4% and a taxable coupon.
Bitcoin's latest pullback has sent shockwaves through the market, with a staggering 512.73% liquidation imbalance, exposing just how heavily traders had been leaning toward the bullish side. As Bitcoin slipped back to the $94,000 zone, more than $310 million in derivative positions vanished within 24 hours. Long traders took the biggest hit, losing a massive $268.07 million as hopes for a quick rebound were crushed. The sheer imbalance between long and short liquidations shows how confident traders were that Bitcoin would reclaim and soar beyond the $100,000 level. But the market had other plans. The drop below this psychological line sparked a chain reaction of forced liquidations, dragging the price lower and deepening investor anxiety. After briefly touching $94,000, analysts are warning that continued selling pressure could push Bitcoin toward the next major support at $83,000. The sentiment remains tense, especially after the excitement surrounding the XRP ETF failed to lift broader market momentum. Despite the chaos, some institutional players remain unfazed. Firms like Strategy continue accumulating Bitcoin in large quantities, sending a signal that long-term conviction is far from broken. Their steady buying has kept hopes alive that a meaningful recovery may soon follow this harsh correction.
You know, over the last year, there's been 100 companies that have added Bitcoin to their balance sheet. The derivatives market and IBIT has surged. The flows into the ETFs have surged. All the major banks have announced support. The accounting has dramatically improved. The tax regime has improved. The administration support at the SEC, the CFTC, the Treasury level has improved. And so, and the technology has improved. You know, companies like Block have rolled out support for Bitcoin on Square and Cash App. So all the fundamentals are good. If you're going to be an equity investor, you have to think for yourself, and you have to have a time horizon of 4 years or longer. And equity markets are either going to lead or lag, and occasionally they'll perfectly reflect reality, but generally it's only a few days a year when they'll be perfectly rational. So if you don't have that 4-year time horizon, and if you don't want to make decisions based on fundamentals, if you simply want to park your money in a stable instrument and pick up a stable yield, you should be a credit investor. You shouldn't be an equity investor. I think the irony is the fundamentals of the industry are so much better today than they were 12 months ago that you've now got an extraordinary risk-reward opportunity. Now is a much better time to invest. You know all the things that you wanted to happen have happened. The market sentiment is negative, but that's an opportunity for the equity investor that makes their own decisions.
Bitcoin whales are making bold moves again, quietly accumulating huge amounts of BTC while much of the market remains cautious. Over the past 30 days, major holders snapped up more than 375,000 BTC, signaling a level of confidence that smaller traders aren't showing right now. On-chain data reveals that long-term holder addresses have doubled recently, and many of these wallets were buying aggressively during the latest correction. Their activity suggests they see current prices as an opportunity rather than a warning sign. At the same time, U.S. spot Bitcoin ETFs recorded a fresh wave of inflows, with $240 million entering the market after weeks of outflows. This renewed interest from institutions adds another layer of strength to Bitcoin's foundation. When large funds like BlackRock and Fidelity start buying again, it often creates real momentum. Institutions building treasuries and expanding their BTC positions only strengthens this trend, helping whales tighten supply even further. Many analysts believe this combination of whale accumulation and returning ETF demand could set the stage for the next major price move. While nothing is guaranteed, the growing alignment between long-term holders and institutional buyers suggests Bitcoin might be preparing for something bigger ahead. If you have been watching so far, thank you so much for watching, and do not forget to subscribe to Bitcoinzilla for daily news all for free. That's all for today's video. Until next time.